Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how's it going this week?
It's going good. We're getting. We got to start with the weather, right? We're getting late, or fall, beautiful fall weather. So it's a blessing.
I recently, so the iPhone 17 just came out, and all the associated series of products, and I got carried away. I had a 13. It was breaking down. My microphone didn't work. I'm like super excited. And I saw that there's the new iPhone Air and shiny object. I wanted it and reordered it and was so excited for it. And then it came the day everybody else got their, it was the day of. And I got it and it just kept slipping out of my hands.
Oh,
and I hated it.
Too slim.
And it was like too thin, too big also. It looked like a Google Pixel for me. And I was like, well, I don't want people to think it's like a Google. And I'm like getting all worked up. And so for the last like 7 days, I've just had so much back and forth with trying to switch out my phone and do all sorts of things that initially should have been just super easy if I got the simple 17 or whatever. Just upgraded like that. But I got carried away by the shiny object. And still, even this morning, have been working on fixing all the bugs.
Yeah.
Apple
even with a case, was it still too slippery and small?
With the case, even like a slim case, it turned into just a big old brick. So
might as well just get the big brick.
Right. It was like sticking out of my my back pants pocket too. I'm like, this thing is huge. Like,
oh wow,
I didn't realize it'd be so tall and wide. And but anyway,
it was funny.
I've got a buddy who's got one of those, like, it's a flip phone, but it's like literally it's like the size of a tablet when he flips it open. I'm just like, no,
wow,
that's way too big. Yeah.
Wow.
Well, John, sounds like you've got some human problems that you need to overcome.
Yeah.
Good segue.
All right, guys. Well, in this episode, we're going to be talking about some common misconceptions or misnomers about the infinite banking concept. Just a real high-level conversation of some things to be aware of when you're getting advice from other professionals about infinite banking. So, John, I'm going to start with you. We're going to talk about, well, actually, Rob, we'll start with you because you've got a story that you'd like to tell about recapturing interest. So why don't you go ahead and just explain high level what was going on here, what was kind of the confusion about recapturing interest?
Well, it's very common, and I have a wonderful clients, married couple, newly married couple, and they totally get it. They totally get infinite banking. They've read the book. They totally get the value of having early cash value whole life insurance policies as your foundational piece of your family banking system. And so we had a kind of a follow-up meeting. They've been the client for almost a year now, so it actually kind of lined up good with just checking in and seeing how they're doing. But they reached out to me because they wanted to really start to put their policy to work, put their banking system to work. And those are just fun calls to have with your clients. And so they were like, okay, so here we got this idea. We're going to start taking dollars out of we're going to get policy loan each month to pay for our mortgage. And then we're going to recapture the interest and pay it back, with more interest so that we can get, more death benefit and more cash value and do the infinite banking process. And and it just reminded me of myself so much. Had the spreadsheet out, going through how you can get some more interest and recapture the interest and put it into your banking system. And I was like, I was you. So I know exactly what you're going through. And I got excited about the idea and how can I put every single expense and run it through my system. But at the end of the day, all you're doing is taking a policy loan out which is then you're getting charged interest for it that you do have to pay back. And so just you're taking dollars out, getting charged interest from the insurance company, then paying it back, and then paying, and then being an honest banker by paying even more interest, right? That's what we're told to do. But in reality, I said, let's just simplify it. Don't take the mortgage out as a policy loan and then pay it back and then pay more interest. Just pay a little, and you're not paying more interest, you're actually paying more premium dollars. So if you have an extra $100 a month that you were going to pay back as interest, just save yourself all the complexity and time. Don't take any policy loans out and take that extra $100 and just pay premium. If you have room in your contract that you have more paid up additions, headroom, take that $100 and just buy more paid up additions. And it was fun to see like the light bulb go off of, oh, we were just making it way overcomplicated. And I was like, yes, I know exactly where you're coming from. That was me making it way more complicated than it has to be. You're just, if you have extra cash flow, just that extra interest that you are recapturing is just premium. So if you happen to have it, then pay more premium, and you are then increasing your family banking system without having to go through all the complexity of trying to move money in and out and policy loans for no good reason. So I think that's a common one because I've had other clients talk about that too, is there's no magic to it. That recapturing interest is just simply paying more paid up additions premium if you happen to have the headroom for it, the room to do it. And that's what we do with our clients is we intentionally create infinite banking style policies that do have that paid up additions room so that you can pay more premium if you have the cash flow to do it.
Right
Yeah,
on.
I think that's super enticing when I first read Becoming Your Own Banker.
Mm-hmm. Yep.
This idea of, wow, I'm losing 34.5% of every after-tax dollars to interest to banks over my entire lifetime. That's like $1 million.
Yeah.
Great. Let me flow everything through this policy and recapture $1 million or more.
Mm-hmm.
And that was the initial kind of understanding I had. But like you're saying, Rob, like diving into it, really understanding, I'm being an honest banker. I'm paying the market rate for these repayments of these loans. And at the end of it, it'll likely be paid off much earlier than a regular loan because I charged more. But I'm going to be an honest banker and I'm going to continue those payments to continue to make additional PUA payments. And if after that and after all your net positive cash flow, you still have lots of additional capital that's being stored in someone else's bank, it's probably time to expand your system and
Right.
create more capacity for your capital.
Right. And then as I've been working and helping my clients through that, like if you listen to any folks who talk about that are followers of Nelson Nash and the infinite banking concept and becoming your own banker, he talks about major purchases. He's not talking about every single expense. And so if there's anything you would have to get a loan for, that's an obvious one where you can use your own banking system to, take a policy loan against it, pay for that thing, create an amortization schedule based upon the market rate, pay yourself back. And then if you had, and this is a key to the magic, the quote unquote magic. When you do pay that off sooner than the scheduled amortization, let's say it's 5 years, you pay it off in 4, continue to pay that in for that one more year. That's being an honest banker, and that's truly recapturing, those dollars that you would have been paying to an outside source. And so that's one of the pieces. But yeah, it's so much simpler. So don't run all of your expenses through it. Major purchases is the key that Nelson was trying to get across with your bank. If you have to go to some other source for dollars, and you have the cash value in your banking system, your family banking system you created, go there. And then if, like John said, once you get to that point where everything's paid off, you have extra cash flow, then you expand your banking system with another policy.
Yeah, I'm reminded of when Nelson used to say, it might take you 15 to 20 years of paying consistent premium before you've got enough cash value to rid yourselves of commercial banks, right? And so, when you're working with a young couple like this, like Rob has been, and they want to run, these major expenses like a mortgage, it's like, well, that's going to take you a long time to actually recapture all that interest that you're paying towards your mortgage. And there's just smarter, smaller moves to be made along the way before you get to that point where you've got enough cash value to say, okay, I really don't need the banks for any of these major expenses anymore. I can run this through my own family banking system. And John,
it gives you the, and Derek, just to add on to that is because that's always like a major idea of all of us. Like, oh, we want to get our mortgage paid off as soon as possible. That's just something you'll want to. We're not we're not financial advisors. We're not giving financial advice, but it's just something you want to think about. Once you build up enough cash value that you could pay off your mortgage, you might decide it's better for my family to use those dollars for something that can bring income into the family. And so it's always kind of that first thing we think about is paying off all of our debt. But some debt is different than, not all debt is created the same. You're getting tax benefits, from the mortgage. It gets cheaper every year, just like a whole life insurance premium. It gets cheaper every year because of inflation. It might actually be smarter to not pay off the mortgage and take that cash. You still have like the good feeling that if you wanted to, you could, but you could potentially take that cash value and then leverage it into an opportunity that can bring income into your family.
Well said. Yeah, John, any comments about that? Using policy loans, not for every little expense, maybe for those major life expenses, major life purchases. But John, talk to us a little bit more about using these policy loans primarily for something that's going to be an asset for you.
Absolutely. And that's another thing, just reflecting back to when I first read Becoming Your Own Banker and always going back to the source of where it all started and where it continues to come back to is I think it's page 80, it's in the 80s, where Nelson says the jarring statement, premium and income should equal each other. But then I've, since connected with obviously the Nelson Nash Institute and part of that community and going to the think tanks and learning more, knowing that Nelson didn't mean that to be initially the case. In fact, he would argue that it likely would take 20, 25, 30 plus years to get to that point. And also arguing that like income itself can be produced from assets that are purchased from the policies, just like he purchased land, just like he purchased, other real estate and other assets. So anyway, that in and of itself was where I got bogged down to think, okay, well, initially I got to figure out how to run all my income through so that then I can survive and pay the bills and pay all my expenses through these policy loans and create this system where I can manage both. And it just did not make sense to me initially. So that's where it was super helpful. I was new. I connected with a practitioner, and it was just like Rob saying, it was just a zoom out, just slow down, knowing that it takes time and knowing that it's not going to be your gas grocery bill, but rather it's going to be those big things, especially early on, like your cars, your roof, repair, whatever it is. And then just like we talk about with water heating up to become steam, all of a sudden you're going to find yourself 10, 15 years down the road with steam and boiling water, and you can move trains with that. You can move things very significantly for the benefit of your family and continue to hockey stick more or less from that point on. It just takes patience and doing the little things along the way where you're not interrupting the growth, you're not interrupting all the benefits, keeping the peace of mind, protecting your family, and all the benefits that come with it. And so that was a big eye opener for me, was when someone just asked me to slow down, zoom out, and understand it's the long-term, like family generational approach to when it comes to that. And then maybe expenses can flow through it, knowing that any dollar paid back in premium is going to be like $4 or $5 or $6 on the back end immediately.
Right.
So plus the dividends being substantial. So that's what I'd say to that. It's not going to happen immediately. It's not even going to happen within the first 20 years, most likely, but you can build to that.
Yep.
Yeah, I think the big takeaway so far is the importance of patience and long-term thinking, which also partners nicely with the next 2 points that we wanted to talk about. John, I'll come back to you again here about this desire for such high cash value efficiency in the first 1 to 2 years is kind of a short-term mindset, right? I got to make this thing as efficient as possible because my dollars need to become efficient, right? What's the downside? What's the drawback of a policy where the design is so significantly weighed to that cash value in the first 1 to 2 years, as opposed to a policy that takes more of the long-term approach?
Yeah, so I mean, it probably comes to a lack of understanding of how this whole process works and how we're positioning the product for the process, right? The product itself is not your Chase savings account, right? It is a similar tool to save and store our capital, but it is not a savings account, right? And that's where I've seen for some clients of mine the disconnect happen where it's okay, we got over the hurdle, which we'll probably talk about next, is, whole life is not an investment, right? It's not the S&P
Mm-hmm.
500. It's not, equities. So that hurdle is done. And then we're like, okay, it's a savings vehicle. And then the next hurdle is, okay, it's not your Chase savings account where you're getting no benefits. The bank is getting all the benefits. But I suppose, yes, you do get 100%, liquidity for the dollars you put in. So that's where it's also then stepping back and knowing this is a long-term process, like we're talking about, and you're not going to get 95%, upfront available cash value, most likely, right? It'll be much less, almost half of that probably. And just like Nelson says, it's the process of creating and controlling your own personal family bank. And that requires a capitalization period. That requires a loss of liquidity up front, which
Mm-hmm.
isn't even that much loss, right, compared to the standard off-the-shelf whole life policies. I remember getting into this business and leaving my job, just passionate about IBC, and some family members and some mentors are like, you're probably gonna like lose money in the first couple of years because it takes a while to get started, get off the ground, get things going. And it was like a shock when I like came out, year one, positive, and I was just still, God's grace there. And but the expectation was that I was going to lose money like in the first few years to build a business, just like
Mm-hmm.
Jeff Bezos with Amazon, all these entrepreneurs like know that it takes time to be profitable. And that's just like building a bank, right? It takes time to be profitable in your own family bank. So you're going to lose that liquidity, but the long-term benefits far, far outweigh, especially like for your kids and your grandchildren and great-grandchildren, what you're sacrificing. And it's hardly even a sacrifice if you ask me, that
Right.
upfront liquidity. And
Yep.
so again, we always revert back to think long range, and don't get wrapped up into that first 1 or 2 year, magnifying glass on the illustration. Why don't you just bring that magnifying glass like all the way down and you see really where you're headed and what you're setting yourself up for?
Yeah, the way that I like to think of it is, this is whole life insurance. It's not an investment. We'll talk about that maybe here in a minute, but just so there is a cost to it, right? I am paying for permanent life insurance. And let's say, for example, my policy, I got, one that's got $3 million of death benefit in it. What would I pay today to have $3 million guaranteed? And it's going to be increasing over the rest of my life. What would I pay for that amount? If I live to be 80, that death benefit might be close to 7, 8, $10 million. What would I pay
Mm-hmm.
today for that? That's
Yeah.
that's what I think, that loss in liquidity in the first 1 to 2, 3 years, whatever it is. That's my cost for a significant amount of tax-free wealth for somebody else. Am I willing to make that sacrifice? And I'd say yes, every single day.
I will say though, it takes a like firm understanding and a firm reminder of what you're doing in those first couple of years. Like I
Mm-hmm.
paid my first premium. I was so like excited about it. I know it's going to change my life. It still has, like it's only gotten better. But the first two premiums, I remember thinking, "Eesh, like I got to make sure things are going to, work out here and like plan for it and know where things are going, especially, with other moving pieces where I was in life. And so, it is definitely something that you have to like keep in mind, but it really does work out. And there are even like ways to, you know, catch up if you want, on certain types of premium and so forth. So, it's definitely worth it, but it does require that like firm understanding and foundation of what you're trying to accomplish.
Rob, I'm going to turn to you here for maybe our last question of the day, right? How fast, this is another common objection or misnomer. How fast can I stop paying premium? That's something that a lot of clients are very interested in knowing of when is this policy going to pay for itself and I never have to come out of pocket ever again. Talk to me
Yeah.
about that.
Well, that as being their coach, that is like red flag number one, that they do not understand what this asset that they have. That is the thinking has not yet caught up to what they have. So yeah, so it's like if you have an asset where you put $1 in and you get more than $1 out, why would you ever want to not do that? And it's they're still thinking of it as an expense and
Hmm.
not as a deposit. We often call it a premium deposit. You're depositing it into your banking system. It's not a sunk cost. The moment you pay your premium, you have cash value that if you wanted to, if you needed to, you can borrow against for life, for opportunities, investments, emergencies. And so it's just a thinking change. Like Nelson says, you need to change the way you think. And so that's our role as coaches is to help coach our clients to show them that that's the wrong way to think about it. This is an asset you are building and growing. You want to put more into it, and every dollar you put in, you're getting more out. It's a positive. I'm sure I can speak for you guys. I look forward to paying my premium because I just love seeing my banking system grow and expand, and I know I can get access to those dollars if I need to. So yeah, that's just a an early year, typical early year thing. Like you, John, you're like, man, just a big chunk of cash I got to pay for this policy. And it takes a little while, just like the steam, like John was saying, it takes a little while to build up your banking system. And the days are long, but the years go by, the years are short, and soon enough you'll start to see this capital build up because we design them in that way. You'll see this capital building up within your policy, then that's really when the light switch flips, and you're like, oh wow, I have all this capital. I have an emergency fund if I need it. I have an opportunity fund. Then it becomes fun and exciting to see how you're building this asset for your family. So yeah, that's a very common early year when during that build up phase, you're capitalizing your system. That's a very common kind of initial feeling, but it's a mind shift. And once that shifts, then it becomes really, really fun and exciting to see what this can do for your family.
I'd say it's also just like scarcity versus abundance.
Right.
Hmm.
Scarcity is pinching pennies, scrutinizing your budget and honestly not like betting on yourself to continue to be able to create value.
Yeah.
And I do see the value in like cautiously being optimistic, like planning for the worst, hoping for the best. But I mean, most 99% of people are probably going to continue to work and earn income and just basically do the basic things needed to survive. And so, because of inflation, because of other factors, your income is likely to increase. So, it's like if you're going to plan for the likelihood, plan for an increase in income, not like you are in Armageddon and it's, the apocalypse and you're barely going to have two pennies to scrape. Like, if that's the case and you're planning on that and you think that's going to happen, don't buy a house, don't buy a car, don't do anything that requires future funding. And all the more, here's something that's going to give you all the more benefit. So why would you approach it all of a sudden much differently? And then in that case, you're committing to something that's going to bring you that value, just like you're committing to a mortgage payment. So that's abundance versus scarcity. I think, breaking that scarcity mindset from, some Dave Ramsey types of, mindsets, some, I grew up in that world of just, always thinking about budgets and pennies. So probably much more advantageous and beneficial to think about how you can produce more and create more value, and likely the income will flow from that. So that's just another aspect of thinking limited on your policies.
And I like to try to track what the smart money is doing. What are these large corporations doing with life insurance as an asset? And so imagine a senior executive and they're getting an insurance policy on somebody who's maybe in their 50s, but that person's going to retire in 10, 15 years. What do they do with that? Do they stop paying the premium and say, thank God we're done, we don't have to pay anymore? No, they actually transfer the life insurance contract to another employee, and they keep paying it until that person retires. And then they transfer it again and they keep paying until that person retires. So it's the smart money, these large corporations are not thinking about how fast can we stop, but rather how long can we be paying this premium for and get the maximum use out of those dollars for a longer period of time rather than that short-term thinking.
Yeah, and I think that's one thing I just love so much about this process and this product of dividend paying mutually owned whole life insurance is it's so you can do it with your family. It's so simple to do. You don't need to be a stock market expert. You just need to find someone to partner with, like John, Derek, or I, and we can help you create the system. And all you have to do is partner with a good insurance company and then pay premium. And you can do all the things we just talked about. There's no magic to it. You don't need a stock advisor to do it. You don't need to be an expert. It's just get a good policy for your family, start paying premium, and it'll just start taking care of itself. That's what I just love about it.
Well said. Yes. And if anybody is interested in learning a little bit more, you can reach out to us at thefamilybankingshow@gmail.com, and we'd be happy to help. All right, guys. Thanks again for tuning into this episode. We'll see you in the next one.
You guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.